Warren Ingram from Galileo Capital is a personal financial planner. He is a financial advisor. He is somebody to whom people come with big and desperate eyes and say, I haven't saved enough. And he says, don't worry, be calm. Warren is near and everything is under control. And to the guys who've got hope. To those who don't have hope, I'm sure he just gives a nice cup of hemlock and then everything is fine. Now, I've got a lovely email from somebody, and such a... once I open it up, do you want to say something interesting so that I can get the email open?
Here we go.
There we are. Thank you. We got a lovely email from Nick. Nick was going to join us on the radio, but he's had a personal emergency. I think he panicked. Nick says, I have a question for Warren Ingram, but let me start with a positive outcome for me from the disaster that is Steinhoff. I'm 40 years old. I started investing into a retirement annuity at the age of 27, and that continues to grow. At the age of 30, a friend of mine and I started an investment club selecting individual equities. Steinhoff was a star performer, and as the years kicked on, our portfolio became heavily geared on Steinhoff. Then came December 2017. Our portfolio has dropped by more than 40% in a single day. Then it's not a portfolio. It's Steinhoff with some other shares attached. But let's not be critical. He's a nice man, isn't Nick? Then, up to then, I was coasting, thinking my financial plans were well on track. The Steinhoff collapse made me relook at my entire financial situation. Well done. And at the age of 40, I realized that drastic change is needed. I bought Warren's latest book and finished it in 2 days. Whilst the reality of my future financial situation became apparently clear, I'm filled with hope looking at some of the case studies in the book. However, I have 2 questions for Warren. And then he goes on to it. Let's just talk about the where he finds himself, and then we'll get to the questions. Lots of people have been burned really badly in this, and you may not even realize that Steinhoff burned you, but it's in your retirement annuity, it's in your company pension plan. I promise you, you've got some Steinhoff in there, and there's been an impact. It may be a 1% impact on the value of your investments, but that 1% value over the next 20 years is a lot of money to you.
Yeah,
and that's why it matters. It matters especially to Nick and his mate.
Don't giggle, shame.
No,
Big
it is. No, I'm not giggling. I'm giggling with sadness.
Okay. Okay. So I think the average balanced unit trust is probably lost in the region of 1 to 8%.
Yeah.
Depending on how aggressive they were on their exposure, et cetera, et cetera. So it was a big knock, and I would say that pension funds the same. And I think the lesson for someone in that situation, you can do nothing in a balanced fund. I mean, with the best will in the world, you're not going to tell the fund manager what to buy and what to sell. You choose to buy his fund or not. But when you're managing your own portfolio of shares, the lesson there is, and I think it's a very good lesson for people who now, for example, are holding NASPAS. You cannot have such a massive exposure to one share and expect any other result than what we saw there, a 40% knock. So if a share is sitting at 60 or 70% of your portfolio, you have to be comfortable that share drops 50, 60%, and what that does to your portfolio. You need to be comfortable with that decision to be able to continue with a portfolio holding like that. I just don't think it's sensible. To me, I would always want to keep a share to a maximum of about 10% of my portfolio. So when it goes to 12 or 13%, I mean, I wouldn't worry about it daily or weekly, but maybe once every 3 months you have a look. And when it goes to 12, 13%, I'd start to say, okay, let me just take a profit of 2 or 3% on that and allocate that money elsewhere, so that if it's my biggest holding and it halves, I've lost 5%, which is still a big amount, but I haven't lost 40%.
You've got to be so careful, though, when you start taking profits on positions in share portfolios, because you start paying tax. Because if SARS deems your intention to be trading rather than investing or rebalancing, you've got to be careful how you do it. You can't be doing this every 3 months when you have a bit of a panic attack.
No, I agree. So I think the law there with SARS is it takes if you've held the share for 3 years or longer, you're fine. So you can then trade out of that share over time after that, and there's not an issue there. You will pay capital gains tax, of course, but you won't be a trader. If you can prove, if you do a transaction within that 3-year period, as long as you can prove that you did it for non-trading reasons, in other words, it represents now 40% of my asset value, and I need to take risk management. You can provide a good argument, and they will be reasonable as to why you do that.
I mean, you've got to, and in the case of suddenly a small cap share starts trading really aggressively, and nobody spotted it, and suddenly becomes a much bigger part of your portfolio, you've got to be sensible about it. It's about financial planning, not dodging tax, and not trying to slenter the system, but being sensible about financial planning and ensuring the risk amongst your investments is appropriate.
Yeah, and I think to someone like Nick and maybe lots of other people out there who are in investment clubs, etc., having one big disaster doesn't mean walk away from all of.
Can you imagine the politics in the investment club? Who was it?
Who exactly decided?
Who decided?
Yeah.
Well, you did. Well, that was 3 bottles of wine later.
Yeah.
Don't mix. Should you drink at an investment club?
After you've made your investment decisions, I think. Yeah. Not before.
And don't then get much cleverer after you've made your decisions and signed off on the investment club meeting to again go and revisit it after 2 bottles of wine.
Well, I think the really nice thing about doing something like that is you make your decisions, you have your 2 bottles of wine, and you write everything down, and tomorrow morning you review. And then you just pop each other a mail to say, is this what we feel? Was it option 1 or option 2? And let's go with that. And I think also there, if you are in that kind of a club, I think the lessons that I've learned here are really valuable for going forward. So don't throw away all the school fees you've now paid. Yeah. And then what I would say if it is 3 or 4 people or more, then have some kind of a mandate. And I'm saying a mandate as if it's some very strong thing, but just say
an agreement.
These are our principles. Yeah. These are the 5 or 10 things we firmly believe in, and let's stick to those. So that thing about how many shares you have and how much you allocate to each share would be one of the principles that I would put into that. And then you don't argue those. Those are concrete. You don't debate that. You're debating around that, but those are the issues that you all agree on, and then there can't be recriminations about those issues anyway.
About those issues, yes. Okay, so here's the first question that Nick has got. The only debt my wife and I have is on our house. While this is labelled as good debt, it is still debt. Oh, Nick, I like this. It's music. This should be paid off quicker than the full term, but the question to Warren is this: where do I allocate additional payments every month? Do I focus on killing the bond as quickly as possible, or rather expand my portfolio by upping my RAs and adding balanced ETFs, or a combination of both? If in combination, which I suspect the answer might be, how much extra should I put into the access bond versus into investments? Best question ever.
So just quickly on what's good debt. Why do we say that there's good debt versus other kinds of debt? Good debt means you're incurring a debt to buy an asset which should appreciate in value, should go up in value by at least the inflation rate, if not more than that. So you're buying something which one day when you sell it is going to be worth more in today's values than what you paid for it. That's okay. We understand that, and we think that's a good thing to do. How much you pay off and how quickly on a home loan versus then your investments. I always look at what the interest rate is on that home loan. So a couple of years ago you could get home loans that were operating at prime -2. Prime was really low, so you found people with interest rates on their home loans of 7%. And in that situation, I'd be saying, if your decision is purely a choice between paying off your home loan faster and investing, I would have a massive bias then to the investing. Why? Yeah. Because you buy kind of a general market exchange traded fund and you can expect around about 13-14% growth a year, and that's pretty much double what you're paying on your mortgage. That becomes a kind of a no-brainer to me. Pay off a little bit extra on your mortgage, but not too much. However, now most people, if I look at it, are paying in the region of 10 or 11% on their home loans. 10 or 11%, if you can expect the stock market over long periods of time to give you 13-14%, that's not such a big difference anymore. And that tells me then that actually I'd start to pay off more money into my home loan than I would to investments. Not to say that you don't do investments, that's not true. But now the bias goes the other way. So now I would rather pay off a bit extra into the home loan and do a little bit less into the savings. So I think for me it is really about that interest rate and how far away it is from the growth that you can expect from your investments. But absolutely, you have to pay off. You cannot pay off your home loan over 20 years. That doesn't make sense. If you can, you pay it off faster, and look at that. You can, all the banks have these calculators where you can say, well, let me pay in.
If I put in an extra, if your bond repayment is 5,000 rand a month, and you can put in an extra 2,000, you will reduce the term of your bond probably by about 7 years or something stupid. I mean, it's that sort of quantum of reduction.
Yeah. So play with that, those calculators, and then say, right, I don't really want to have a mortgage for longer, let's say, than 12 years. I mean, to me, that would be a good and realistic goal to aim for, unless interest rates are high, in which case you just swing, as much as you can into the mortgage, and then, it might still be 12 years because interest rates are high, but at least you're not going to drag that out to 15, 16, 17 years.
There's nothing scarier than rising interest rates. We're not in that cycle right now. But if you've got a big debt burden on your house and it is a bit of a drain on your finances, then the argument comes in, interest rates will go up at some point, higher than they are now, maybe 1 or 2 percentage points, maybe 5 percentage points in the time of a financial crisis. You want to be able to always afford the minimum on your bond payments. So if you're stretched right now and you come into a bit of a windfall, reduce the burden so that in more difficult times you can cope with maintaining your payments.
Absolutely. I mean, I think, no question. I mean, if you're stretched with debt, there is no other priority other than, get the debt down. You don't start worrying about savings or replacing cars and the like. And especially if your only debt is your mortgage and you're stretched on that, because you don't really have a lot of room to play with here. You can't go and sell your house quickly and easily. For example, if you were stretched on a car, you could actually flog the car.
No, absolutely. But also, it's usually at times of crisis when suddenly people find out that they're in trouble and you try and sell your property at exactly the wrong time in the crisis.
In Cape Town.
When there's no water, for example. And suddenly you've got a house that you thought was worth 5 million and suddenly nobody wants to give you 3 for it because there's just too much risk associated.
And I mean, I can't tell you the number of conversations I've had with people in Gauteng, for the last sort of 8 months of last year, with exactly that, saying, when they looked at their valuations of their houses, they were 5 million or 8 million, and the reality bites, they either can't sell it at all, or they're losing, 30% of the value of their property if they just want to flog it. And
don't ever be in a position where you have to be a desperate seller.
No. Agreed.
Okay. Then, where portfolio value at retirement. Now, in his book, this is your book, by the way, Warren mentions an investment value of roughly 2.4 million rand in order to get an income of 10,000 rand a month. You concur?
Yeah.
Were those the numbers? Good. You want to earn at retirement. Do I interpret this correctly? So if my lifestyle requires an after-tax income of, say, 100,000 rand a month in today's money, I should aim for a retirement portfolio of 24 million, and that 24 million will obviously be a balanced combination of RAs, living annuity income, ETFs, direct equities, properties, etc.
Yeah, so the formula to me is take your expenses after tax and make that an annual amount. So if you're spending 100,000 a month, well, good for you, because that's a heck of a lifestyle. But you're spending 100,000 rand a month, that's 1.2 million a year, and you multiply that by 20. That's the way you can come up with that sum for yourself. Why 20? Because it's actually a calculation of percentage. So you say, well, 5%. If I draw 5% from my capital on an annual basis, that's sustainable. Why? Because that balanced portfolio that he's talking about of cash, bonds, property, shares should give you about 11% a year over long periods of time. So if you draw 5% a year and the inflation rate is 6, then you know that what you're drawing every year will go up with inflation at the least. So you're not losing on the purchasing power of your money. So that sum is accurate. I just think, and focusing on the vehicle, in other words, whether it's a living annuity or etc. When you're 40, I'm not too worried about that. I'm more worried about saying get the mix of your assets right. So he cannot be continuing to be over-invested just in shares, and particularly in a few. He needs to have an exposure to property, bonds, cash, local, international. That's probably a more important decision right now than, how much do I split between the two. And then I did see in his questions, he didn't really touch on tax-free savings. So I think, if he's looking at mortgage, paying off his mortgage faster, et cetera, one of the things I do say, okay, fine, do pay off a bit more on your mortgage, especially if you're paying about 10% a year interest. But then, use your RA contribution. That's valuable. The deductions that you're allowed, and then your tax-free saving. And then if you've got anything left over, then do the extra additional savings.
A fine thing. It really is. Can I tell you why all of what you've said in the last 15 minutes is completely irrelevant?
No.
You don't want to hear?
No, of course you can tell me. I can't believe you.
Because the world is closest it has been to total annihilation since early days of the Cold War. The Bulletin for Atomic Scientists has warned on Thursday that they have moved their hands on the doomsday clock 30 seconds closer to midnight, largely due to growing risks from the North Korean nuclear crisis and climate change. A decline in U.S. diplomacy under the Trump administration and threats to democracy from online misinformation campaigns also convinced the experts to move the timeline forward. The Bulletin, which has tracked the risk of of nuclear apocalypse since 1947, says the world is now just 2 minutes from the symbolic hour of global destruction. This is the shortest window since 1953, the year that Russia first tested hydrogen bombs. In 2017, world leaders failed to respond effectively to the looming threats of nuclear war and climate change, making the world security situation more dangerous than it was than a year ago, said the bulletin in a statement.
How depressing.
It is massively depressing.
So,
So spend like there's no tomorrow.
No, and my thing would be, I think we overblowing the North Korea thing. I think it's very much a Western media thing. If you look at what the South Koreans think, I think they have a different view on that. But the climate change is obviously a huge concern, especially for your kids.
Please talk about S32. Are you not meant to Section 12J? What are you talking about? This person's asking questions. Please clarify if you said do you know what S32 is?
No, I think it's a Section 12.
Okay. Yeah, Section 12J. Can we talk about that next week? Or are you comfortable talking Section 12J?
I will be.
You will be? Must I get somebody else to do it?
Yeah, I think we should.
Okay, I'll get somebody else to do it. All right, we'll get somebody else to do it. There's a lot of advertising going on right now. Big expectation that tax rates are going to go up substantially. The finance minister earlier on the Money Show intimated as much as in terms of cost cutting and raising additional revenues. I was talking to a tax expert today who says this is the year for VAT, but that's what they say every year. One year they'll be right, and you say, look, we were right. They've been calling it for the last 20 years. But yeah, Section 12J of the Income Tax Act allows people to make tax-free investments in particular asset classes. It's a wonderful opportunity, but my sense of it is that it's becoming a bit like the Bucky Brigade in the building sector, and that it's all becoming a little bit hairy. So we need to warn you about the pitfalls there and tell you why it's a bit like Bitcoin. Potentially, if you're not careful. All of that on not the next Money Show, but on a Money Show next week, because Warren's to check and to do.